Hello, everybody. Welcome back to 21st Century Renaissance, and welcome back to another open interest newsletter breakdown on GameStop. I'm your host, Dr. Michael LoPiano. Wonderful to see you all once again. Bit of a slow day yesterday, but we did end up getting that recovery as anticipated pre-market, right? A little scary in the pre-market, seeing us kind of head down there, seeing the market tank overnight like that. Of course, there was all of this concern and hubbub over what is this, DeepSeek. That's it, DeepSeek. Right, of course, DeepSeek, nobody ever heard of this before. All of a sudden, it's on the App Store, and now we got to have 500 mainstream media things about it and get YouTube videos pushed to us and whatnot, right? So whatever, right? Maybe this really did cause this, but in any case, no matter the concern, the options market told us the story, right? This data is certainly very powerful, especially being able to look at and understand gamma exposure. So we'll break down a little bit of what actually occurred kind of pre-market heading into yesterday, what that was all about, kind of revise, in a sense, review some of the things we talked about yesterday and look and see how that played out, as well as try to look into what our data is telling us now and what that's going to mean. So we're going to be thinking a lot, just as I've said, about context. A lot of GameStop's price action is going to be driven, especially by market context, given this low volume, sort of low attention kind of environment, right? Certainly eyes are off GameStop at this moment. But hey, that's when we see eyes are off GameStop, when we see the price moving kind of flat and we see IV flattening out, that's when we are moving into these situations where some possible setups to return to the upside come. So we'll be thinking about whether we can see any of that in our near future. So we'll hop into this right away today. For those of you who may be joining us for the first time, every day prior to market open, I post analytics on a technical and options methodological basis on my X page. You can view this if you would like prior or during our breakdowns here. That's what I focus on. You can find a link to this down in the description of this YouTube video, or of course, if you're watching this on X, it's right at the top of the page. So today, in fact, is the Sneeziversary, right? So this is the 4-year anniversary of GameStop's all-time high at the time, an intraday high of over $480, and pre-market high. I remember it was way up in the 500s. I remember being up early, right, watching the Frankfurt Stock Exchange open and just watching the price continue to just soar. Pretty sure, right, as it kept going up there. Certainly for me, I was excited. I was like, oh my God, it's gonna be worth thousands of dollars a share. Every dollar you spend is it's free money, right? Something like that. I remember thinking back in 2021, when I was certainly more optimistic, more naive about how all the black box stuff behind the scenes actually goes ahead and works, right? Certainly, I like to think myself, many of us, myself included, are a bit more wizened in the time that has passed since, but it is a very interesting thing to reflect in hindsight about that experience. So, happy Sneeziversary to everybody who's been a part of this saga, right? Going back at least 4 years now, some of us back in the 5-year club. I don't know how many people are out there who are back in the 6-year club, like Roaring Kitty's original DD analysis. Certainly not me. I mean, that's a real privilege if you had access to that stuff back in 2019. Not me. I can't claim to have had the opportunity to have had that. But in any case, big thanks goes out once again to Goat Zubak for sponsoring today's post, today's video. Thank you very much for my coffee today, my friend. Goat Zubak going ahead and treating the channel to 10 coffees in a row. So thank you very much, Goat Zubak. And of course, big thanks always goes out to Scruffy, Dad Scruffdo. Thank you so much, my friend. Blessings to you and to your family. Appreciate your support and your trust as well. So thank you very much. And thank you as well to everybody out there who has supported me in the past or will support me and us in the future in our efforts to try to make sense of what's going on, of course, in GameStop and the general market with respect to GameStop. So thank you very much as well. Yeah, there we go. Right there's our all-time high. I put a little green circle around it so that you knew it was super high. Um, so yeah, so okay, so what are we looking at? Like what actually happened yesterday in the market here? So yeah, right. I mean, we went right off that put wall down there around 590, right? SPY 590, a little bit, maybe a little bit higher in terms of SPX. Not exactly sure, maybe about 559.10 over in SPX. But right, we talked about this put wall level, right? Well, I was breaking stuff down yesterday, right? We were basically around here, and I was like, I think, right. Every time I go out here, like, I don't have a background in this. I'm not an expert. I'm very open about this, and I hope everybody knows, right? This is my background is not in finance. My PhD is not in market charts and stuff. But I come out here, I try to understand these methodologies. I try to make sense of the information that comes my way and see sort of what works as the best functional model for trying to predict what's going to happen, and just to be beholden to that. And sort of some of the things, especially that I've stumbled on, I've been very lucky to stumble on, or been open to come to understand, especially in terms of what I try to understand in terms of of dealer gamma exposure, trying to understand price movements, under this sort of operable thesis that really what's driving price action on a regular day basis, not only in GameStop, but in the market in general, is traders. Well, I should say traders, but the relationship, the interaction of traders dynamically with market maker portfolios, and how market makers hedge the positions that they open in order to profit off of, principally, right? I mean, they do so with equities, but principally off of the options market, right? So how they have strategies that are oriented towards the derivatives market, how to balance and hedge those positions to remain delta neutral, right? To remain unexposed to changes in the price of the underlying with respect to their options positions, and how their hedging behaviors actually move the price around, and how that can manifest itself in terms of supportive levels or resistance levels throughout the day, and how that can signal when the price is going to go through major reversals. So, right here, 590 was our put wall yesterday. Pointed this out. We had already started to reverse, right? We went through this real quick bounce back up. We were at about 593. And basically what I said yesterday was, hey, if this is going to be anything like what we saw last August, the same pattern happened. The same pattern happened. This is what made me think that the whole DeepSeek was really more of a deep fake, in terms of, oh no, it reached #1 on the App Store. ChatGPT beware. Maybe there is a real thing there. But that was probably these AI companies and such. The market probably figured that out months ago. Like, people who are in the know, this stuff has been known for a while. I've seen people try to, people have come out and said this, like, this information is really kind of old news. Like, this is December stuff. Why is this only being reflected in the market now? And I think certainly I'm of the opinion, although, right, how can I have conclusive proof of this, decisive proof of this? I can't necessarily. But because of our pattern here looked almost exactly like what we saw back on August 5th after the last Bank of Japan rate hike. So what I really think this is, a number of other people have said this too, this was our reaction to the Bank of Japan rate hike. Now, it was a bit delayed. We opened slowly. We had this kind of fake out. And I even called this out on Friday, right? We didn't do anything. I was like, they decided they were going to go with the rate hike. Did we already process this before, or are we just stalled? And that's what I titled my article last Friday. I said, Bank of Japan stall. And then, then moving into today, right? Everyone had a chance. All of the people who were in the know, who knew that they were going to rug pull these positions, the people who really have access, right? Because let's think about this, guys. Like, come on now. I don't have access to borrowing yen. Like, I can't borrow this at 0% interest rates. I can't go call up, the Bank of Japan and say, like, hello, I'd like to borrow 1 billion yen so I can go buy infinite securities and pump NVIDIA. I can't do that. I don't have the privilege to do this. So obviously it's not people like me. It's not people like you. It's not retail investors certainly that are doing this. I don't know to what degree, even like small proprietary trading firms or hedge funds. Like, how big do you have to be to actually like borrow significant amounts of money in a carry trade to then go ahead and pump up the U.S. equities market? I'm not sure. I don't necessarily know how that works, but I do know that I can't do that, and I'm not somebody who's responsible for that. So, right, these are major banks. I have to imagine major firms that are involved in this type of carry trade. And okay, they know when they're going to pull the plug. Like, they know when they're going to rug pull the market. They know when they're going to pull their equity out and cash out this trade. And It seems to me like they just kind of left things floating up there. And maybe they started to unwind a little bit because we did trade down off that all-time high on Friday during the day, during the second half of the day on Friday. And then like who rug pulls like all of this? Do you know how much money it would take to move the market down from, move SPY down from 610 to 590 in a couple hours? Is like trillions of dollars that are being pulled out of this. Something of that sort. So, that's what I think we saw pre-market. It looks exactly like what happened. Now, is it as dramatic as what we saw back last August? It's not to the same extent as what we saw last August, but we did see that rug pull last August that looked a lot like that. We also sort of went into that, right? We went into the August event on a downtrend, whereas we had a kind of brief reprieve, kind of pop back up to the upside to a new all-time high just prior to this. But what happened, right? It looked like, oh no, like, is this going to cause some kind of pain? But right around 6 a.m., 6:30 a.m. Eastern time, we got that put wall test, as I mentioned last time, right? Put wall is a term that's especially used by spot cam. I don't know to what extent it's used elsewhere in the industry. I have no industry experience. But this is a put walls, right? When you have a very large accumulation of dealer short puts, there can be something, as I understand it, of an implied volatility cushion when you have a real concentration of that, such that the price will stall a bit when it gets to that level. And then traders can then go ahead and use that as a reversal and then kind of walk dealer gamma hedging kind of back in the other direction, right? So just as quickly as it fell down to that level, you can then push it back up. And what I anticipated happening was that once that bounce was confirmed, and we did see that here, that what would happen was traders basically immediately, as soon as things opened after seeing that move, or because even here, this is like 595. Didn't we open it like 590? Not even 595. That's like 594. Right. We opened at this level. That's super down from, like, think of all the people who opened puts on Friday up at, like, for this week or for Monday's daily OPEX, daily options expiry, I should say, who, just like, what happens if they open 600 puts? Like, all of a sudden they're in the money, right? Deeply in the money. So I anticipated a bunch of people would go ahead and close their puts, and that does look like what happened. Instantly, we shot up, right up over almost, right, went all the way up to kind of test, didn't quite make it to 600, almost made it to 600, kind of cooled back off a little bit. And then what it looked like was we had some time. We did spend some time over SPX 6000. So we did get up there, not quite in SPY. But it did look then to me, what I figured, I was like, okay, well, I mentioned this. You can go back and watch my video yesterday. I'm pretty sure I pointed this out. I certainly pointed this out in the article, the idea that, okay, once we get these puts closing, like, traders are going to go ahead and open up calls to try to capture that up move. So, this went pretty fast. It would have been probably some bought some calls, but then IV got super high. So let that kind of cool off a little bit. That's what we saw. And then we saw traders probably enter into calls down here, closer, slightly below VWAP. And then, and we had a couple runs, but the real one that mattered here that I'll point to in a second was this one that happened right at the end of the day. And this is specifically because enough calls were entered, enough puts were cashed out, that 50, so SPY level 599 ends up being the beginning of a call gamma dominant zone. So where traders are net long calls at these positions, which means dealers are net short calls at these positions, which means as the price goes up and these contracts move into the money, dealer gamma hedging is going to work antipathetically to buying sentiment. So as traders buy calls, obviously there's going to be sympathetic delta hedging, but antipathetic gamma hedging, right? So as those strikes move into the money, gamma values go down, even though delta values begin to go up. Gamma, of course, is change in delta, the rate of change in delta. So the degree to which delta will appreciate or depreciate per dollar change in the underlying security or ETF, whatever it is, if it's a stock or a security. A stock or an ETF, those are both securities, that as call dominant strikes go into the money, dealers will then begin to sell gamma hedges even as delta continues to go up. So gamma hedges, right, reflect potential changes in delta, but that level of gamma hedging is going to peter out. And so you're going to get resistance as you right? You're going to stall a bit. You're going to get dealer hedging as a volatility suppressant as you move these call dominant strikes into the money. And then once they move into the money and you move through that, then you can sort of move up the chain, but you move into this more stable area is the point, where as call dominant strikes are moving into the money, assuming that dealers are net short calls at these positions, as those strikes move into the money, dealers are then going to sell their gamma hedges, and it's going to decrease volatility. So you're going to have to invest more capital to get bigger moves out of that. That's true going up. That's also true then going down. Once you get enough into this zone, then as the price moves down, then strikes on the other side are then going to be supportive, because gamma values are going to spike as the contract moves at the money. So gamma values always spike. They're always highest when a contract is about to, or is in the process of moving in the money, or is in the process of moving out of the money. So whenever you get close to a strike, gamma hedging opposition, if it's call gamma dominant, if dealers are short gamma for those calls, then it's going to resist whatever the current trend in price movement is. So when SPY can move into these call gamma dominant positions, assuming of course that dealers are short that gamma, it's going to mean that you're going to be trading in less volatile conditions. It means that regular movements within the options market are going to be not quite as broad. IV is going to go down, and we see that reflected, of course, within the IV levels and within the VIX, the volatility index. As the price goes up, as we move into call gamma dominant territory, you see that. You see gradual, slow, grindy moves up, not huge swings. And so the VIX goes down, the price goes up, right? Then traders can come in, they can build out more call positions. It can be more stable, more stable, more stable. So that's you see that dynamic reflected there. Okay, so 599 established itself as a call gamma dominant position. 600 is a little volatile right now, as we'll take a look, right? So if we scroll down a bit, you can see, right? So 599 established itself heading into today's trading as a call gamma dominant position. That's call GEX there. 600, a little volatile, not terrible, right? A little slippery because we still have quite a few probably trader long puts there as hedging to protect against the downside move into this territory. As long as we keep moving up through here, as long as we're above 599 and we're trading in this area, which we are right now, we have been doing pre-market and we were in the overnight market. We did ensure that as of our movement heading into the end of the day. Yesterday, right? That last kind of blip up there, up above 600, ensured that we would be in this zone. And so, we do have some stability. We do have some stability in here. It's not like kind of obvious, let's march higher stuff. We could get that. We have to see what things are going to look like in terms of, we do have this Fed meeting on Wednesday. There's probably going to be some apprehension heading into that. It does look like no changes in the interest rate are expected as a result of this meeting. I saw somewhere like, the move is 97 point something % priced in or something. I don't even know how that's calculated. But in any case, there's still a chance for something unexpected to happen. So I wouldn't be surprised if we don't really take off, if we kind of go a bit sideways or stay in these kind of low supported area today. If we do get something that's unappealing, we could kind of shift down in here. What's really kind of like, we could run this again right in the middle of this range, 595, 596, put gamma kind of spikes a bit. So we would kind of run through there pretty quickly. It's sort of neutral below there. We have this, neutral area a little bit at 593. Not a ton of put gamma. Maybe it would insert between 595 and 590. The real critical level is 590. As long as we're seeing SPY, SPX kind of stay above that 590, 5900 level, things aren't crazy. We start to worry about volatility moving into the lower 590s, the mid 590s. But, okay, we still got that put wall there at 590. But if for some reason 590 intraday does get breached, that's like, whoa, yeah. We're probably heading lower into the 580s, 570s to kind of feel something out, or maybe we're gonna, we move back into that lower area. Maybe it's, look for some consolidation, or maybe we move into a bigger downtrend or something like that. But while we're up here, that's not as much of a problem. Okay, right? Of course, obviously, always talking about context. What does this have to do with GameStop? Right. Well, obviously, as I pointed out yesterday too, GameStop came down just as it did in August with the broader market, but then right, we recovered with the market as well. Similar moves, similar right. What we saw here, mostly flat trading, recovery with the market, and then just kind of cool off for the rest of the day. We stayed in the lower half of this range bound regression sub channel, hanging out with our moving averages, not doing all too much. Traders picking up a couple scalps here several times off of this line, using VWAP as a resistance. So two sort of big trades here. These two kind of, oh, I should make this bigger. Now you can see. Yeah, so like these two little humps here that you see later in the day, 1, 2. So these are, this one a little bit, right? This one's playing with VWAP. So this here, there may be a little bit of shorting involved in here, maximally about 200,000 shares. I pointed this out in the article. Not looking at too much. There was not too much kind of direct shorting or manipulation of GameStop yesterday that I could tell. Maybe a little bit to kind of get this negative trend, to kind of nudge it to the downside to get this move rather than have it track with the general market, which was recovering. But yeah, these moves struck me, with the exception of this, right? We had a big like 140,000 share order come in. Didn't really do much. It did this. Maybe this got shorted back down or something. This one kind of red move we're looking at in this area does look like shorting, right? So we see the volume kick up, and it's just a straight kind of red line down. That looked like shorting to me. Maybe 100K shares here, 100K shares here, but that's kind of the most that I was seeing. Could have been back here too, in this area. So, but yeah, these are scalp moves, right? These are options move. These are trader based moves. This is pick up the trade off of the regression sub channel, this sideways channel, pick it up and then sell it VWAP, and then pick it up again and then sell it VWAP, right? So these are option moves, and then trade down and do it again, and then play on top of this in the overnight period, in the after hours period, into the pre-market period, which we're looking at now, right? And we look to be still open on top of this. Where's our current? Oh yeah, we're just like at the closing price right now. So yeah, close at 26.97. That's our lowest close in a while. But I would say, right, and I pointed this out, in this context, I'm generally looking to see like, okay, are we getting lower lows? What we want to see here is we want to see like the question I have, or at least I can say this, obviously make your own decisions, not trade advice, not financial advice, but like what I'm looking for as far as, okay, do I need to adjust my position? Is my current thesis, right? Because my current thesis about what we're doing right now is, okay, we're in a volatility cycle. We just we just went through a big sell-off phase. We just went through a major shorting phase. This coincided with the downturn in the market. When the market recovered, we stabilized. So IV is sold off tremendously, right? In a period of like 6 or 7 trading days, we lost 50 percentage points in our overall IV. We're approaching 52-week lows. We're not quite at 52-week lows. We're probably about 3 weeks of flatness away from a 52-week low. So that tells me like, okay, we're in this phase. We're in the approaching 52-week lows phase. When we have some time to hang out at that lows, that's going to offer an opportunity to options traders. It's going to offer an opportunity to institutions that are, ready to move us back to the upside, right? So let's see, if any of these positions were strategically failed. Let's see, when did they enter into these positions? 14th. So 2 weeks. So yeah, we have about 20 days, right? So in that kind of T plus 35, T plus 34, plus or minus a couple. Yeah, that window is coming up in, let's see, 1, 2, 3, basically heading into February OPEX. Basically heading into February OPEX is around what we're looking at. So mid-February, we have institutions reporting actually just before then. So we've got institutions reporting their quarterly filings. This would be the period stretching September 30th to, I think, January 1st, something like that, is what we're looking at. So that's kind of the target, right? We might get some little up and down prior to that, but that's basically, so that's my model. That's what I'm working with now. That's how I've come to understand how these volatility cycles are structured. That's about how long they take. we don't have like an earnings or something else in there to disrupt that like we did. So for example, right, a lot of this, I would really encourage you to go and take a look at Reddit user Gherkinit's, right, When the River Runs Dry write up. He does a very good job of describing, of framing this, of giving some very good analogies about how this works and how institutions profit off of this. What I would say is that in this, right, he wrote this several years ago. He wrote this in the context of 2021, and he focused on OPEX as what he didn't quite include at that point. But what I think is important to take note of, and this is not to say that he was ignorant of it. It just doesn't necessarily come through in that write-up. Right, is earning periods as well, because earning periods also function, as IV appreciative events. In fact, there's big run up, which I've been talking about for about 2 weeks prior. This was true prior to 2021. This was a little less clear in 2021. This was completely obfuscated in 2022. So of course, when Gherkinit was working on and publishing this stuff back in 21 and 2022, the earnings run-ups weren't really happening. So I'm not surprised that didn't factor in then. That wasn't an operative factor when he published that. What does seem to be another condition at this point that factors into those volatility cycles is the placement of quarterly earnings. So in September, when we entered into a cycle, we entered into the cycle in the beginning of July. It ran down through all of July and into August. And then this is why the end of August, we got those kind of 2 back-to-back weeks of big volatility upswing, right? We went from like in the 70s, like 75, 72%, 71% implied volatility. And then in 2 weeks went to 150% implied volatility on, and move from like the 19, well, did we really go back down? Yeah, I guess we did, like kind of upper 19s, lower 20s, all the way up to about 25, right, into earnings. And part of that was what it seems to me from this standpoint now is we had an incoming FTD cover cycle. So into July OPEX, we had huge shorting, huge sell-off. It did indeed look like there was a bit more distribution there. It didn't look like we had as much distribution at the beginning of this last cycle, but the timing was a little bit different. But in any case, we did enter one there mid-July, just prior to July OPEX. After July OPEX, huge sell-off, got the Bank of Japan thing, another huge big sell-off, GameStop, all the way down to 1750 pre-market, opened at 1850, very quickly went back into the 20s on August 5th. But then kind of mild recovery, flatness, volume absolutely in the gutter, like moving multiple days below 3 million volume on basically our current float at that time, basically our current total shares outstanding, very low. And then basically nothing happened until August 29th, where this was probably when the first of the strategic fails to deliver from prior to July OPEX started to get covered. And at the same time, earnings was announced, right? The actual earnings date, which was published, right? The estimated earnings date was estimated to occur September, I think, 4th. And then Ryan Cohen said, no, it's going to be September 10th. So there was a little question mark about when that was going to take place. But then, my gosh, if you're setting up this strategic fail and cover cycle, like what you could not set up a better time to start that up move, because you've got your 2-week IV appreciation going on in the background. So rather than have that up move come in, that Thursday, the 29th, that Friday, the 30th, and then the following Friday, September 6th, right? Rather than have those 2 consecutive weekends kind of, okay, the price movement's the same, but then rather than have IV kind of go from like 70 to 102, because now after this, and you've got a Roaring Kitty tweet coming in on September 6th, now that following week, now you're the 2 days prior to September earnings. And what do you get? You get that run up to 25 on Monday, and now IV's at like 145, 150%. intraday, using this Schwab metric, right? Very high. And then you can short it basically the next day into earnings, just sell calls all day. And then earnings comes out, whatever it is, even if it's better than expected, short it. Why? Because Ryan Cohen's making another 20 million shares available at the market. And so you just plummet from 23.85 or whatever it was back all the way down to 1950, basically overnight. Like you open the day at 1950. And that's what we saw, right? So factoring in those quarter, and I suspect, right? I suspect that the regularity of institutions to be able to pull off these volatility cycles for so many years after 2021 may have given them the confidence or the comfort to be able to move in some of these, rework these appreciative earnings-based IV cycles. So insofar as we're concerned with what's coming up in February, we don't have one of those, right? We don't have an earnings cycle coming up in February. It's not coming up until the very end of March. So in order to cover the FTDs, the strategic fails from, this period, maybe the 13th, 14th, 15th, maybe even stretching a little bit far beyond, back before then, because we started to sell off prior to that big heavy shorting day on the 14th. But we got heavy shorting on the 14th. We got shorting that looked like it was actually covered the following week. So this would have been last Tuesday. That looked like it was covered. And you can go back and check out my video about this. That looked like it was covered instantly. So I doubt that was failed. But despite that heavy shorting, right, liquidity is going up. So that suggests fails. If the stock is being shorted to heck, the price is not recovering, and shares available to borrow are going up, liquidity is increasing. That says creation orders on ETFs. That says strategic fails. So I suspect basically like what this is looking like now, and how to make this comparison to what was going on with the last Bank of Japan hike in August. Probably about another 3 weeks, just like we had in August, about 3 weeks after the Bank of Japan hike. Flat, volume down, slight recovery, maybe mild. That's kind of like, that's what we're looking at in our options. I've been talking about this for days. I'll show you the numbers again. They really haven't changed that much. There's a couple things I want to point out to you guys. There's not that much, right? It's still basically, max pains, 27, 27.50, 27, 20, it's not really, those aren't going anywhere. We don't have a ton of new contracts being open. Options numbers going down, basically looking like they looked last August. We've got volume numbers looking like they looked last August. If this stays up for another 3 weeks, right, the IV basically says, if we keep this up and we look like this, we're going to hit 52-week lows again. We're going to hit them in about 3 weeks. That's when we're going to get institutional filings. That's going to be about the end, right? So if there were strategic fails, which it looks like there were, if there's strategic fails that occurred on January 14th, January 15th, then those, the necessary max date, the deadline for those is going to be around just a few days prior to February OPEX. So do you use the publication on February 14th or 15th of these fails? Here's another interesting thing you'll also find out who still has open short positions, because beginning of February now, it's beginning on the 2nd of January this year, which our good friend Roaring Kitty pointed out to us, Keith Patrick Gill, pointed out to us actually in his last meme, right? In his last Futurama meme, right? The date there is January 2nd, 2000. And January 2nd, 2025 of this year, it has become now mandatory that institutions that have a short position open in excess, I believe, of 10,000 shares, that may be something I'm taking from Reg Show, but it may be similar. It may be a similar number. If it exceeds a certain threshold, then they must file not only, right, so you have institutional filings for accumulated positions, for long positions, for 13Fs, but now you have to file a 13F parentheses 2 called Form Show to disclose any outstanding short positions on securities that exceed a certain amount. That must be done no later than, I believe, the 1st of the following month. So we will know who still has open short positions? Basically, in a few days, we will know if anybody has open short positions on GameStop. Okay, now they probably know that, so their strategic fails. So the GameStop fails have been covered, but the fails have not been covered on the ETF. So it'll be up to our ETF hunters out there, you guys who love to go through the ETF data. Richard Newton is particularly good at this with his spreadsheet. It'll be up to you guys to be able to see if you can spot any anomalies out there. Well, now here's the other thing too. We'll know when there are outstanding short positions, but we won't know when will we get the fails for them. I wonder if we can get the fails at the same time. That'll be interesting. Is it 15 days? I think we wait 15 days for the fails. Where's my fail page here? I think the last fail, yeah, we have fails up to the 30th. So no, we will actually. If there were fails on the 14th for GameStop and ETFs, we should get those on the 1st. We should get those on the 1st. We should see who had outstanding fails that day. I expect there will be some fails on that day. Of course, we'll have to track it down through different ETFs, but if that's the case, then we should be able to see that. We should be able to see any new fails by the 15th. Anyway, my point here is around mid-February is when the projected close for this cycle would be. That'll be, we have a lot of things kind of culminating there. Now, do I think it's going to be as big of a move back to the upside as we've seen recently? I don't think so, because we don't have that sort of lining up with earnings like we did, say, in September, like we did in December. But we could be sort of something mid-range, could be something on the smaller side, and then that could get shorted too, and then they could time that so that would work out with. Yeah, then that would be positioned perfectly to then go ahead and do the same thing for March OPEX. Yeah, and then basically set something up again, maybe set something up like December. So getting a little spicy, right? It's easy to have the morale kind of sink a little low when we see some of these shorts come in. But whoa, baby, we're consolidating around 2650, 27. We got IV getting low, looking like we're framing up for another volatility cycle coming in. I don't know, right? Not financial advice, not trading advice, but I get a little. I get a little tickled. I get a little tickled at the thought. So it makes me feel a little bit silly. Now, okay, all fun aside, right? So we had some stability going in yesterday. Doesn't look like there was a lot of shorting. Obviously, I always have to point this out. You want to know there is this liquidity here, right? If for some reason, right, like Richard Newton has been also tracking, he's been tracking swaps as well, pointing out the possibility that, hey, these guys like to manipulate the price down so that it lines up with swaps, so that they can roll these swaps at a favorable price, right? These are the swaps that they bundled all the way back 4 years ago, right? In order to kick the can of this melt up on January 28th, 2021, right? So they packaged all these problems into a swap on the 29th of January. So they want to roll this swap, right? That's Richard's argument there. So there's 1.9 million shares that are available out to borrow that can be shorted. So always important to keep this in mind. I never put 100% confidence in technicals. I never put 100% confidence in options levels. They're high probability. But because this dynamic exists, because they can create synthetic liquidity and refresh this pool and dump 1 million shares on the tape, they do so tactically. I've pointed out this multiple times. They know these levels too. They know people bet on the technical levels. They know people enter trades on the options levels. This is common knowledge now. So if you're going to deploy short shares and you want to have maximum disruption, you wait until you get right to an entry point, and then you, boom, targeted, concentrated share volume right at that level, so you cause maximum disruption. maximum disorientation, maximum demoralization, and then people leap out of their positions, and then you get extra momentum pushing that to the downside. It moves out of that kind of hedging range, and you then get that kind of teleportation effect. So very important to keep that in mind when going into this. That's not necessarily to say, hey, go, panic, be afraid, FUD, all that. Definitely not, but always important to keep that in mind. That's what we got here. That's what this was, right? Look when this happened. Look at this. I remember I was talking about this. I got through for a loop. I got thrown for a loop too, right? Look at how many months here. How many weeks, how many trading days did we have scrupulous respect of these lines, scrupulous respect of our resistance levels, all of this. So much. I mean, like, December was an incredible month as far as what, like, I've never had a trading month like that in my life with these, right, with these moves. It was really incredible what like everything worked as it was supposed to. And that's exactly why this worked for them, right? That's why this worked, because everything worked exactly as it should, according to the TA, according to the options levels, for 6 weeks. It was perfect. It was perfect. That's why this worked. Shorted through this. Then all of a sudden, we went from 6 weeks of every technical level in their mother working to actually none of them are going to work. Screw you guys. So important to keep that in mind. Important to keep that in mind. Speaking of our technicals, not a whole lot to comment on here. Obviously, nobody likes to see we're just starting to tuck under that trend line there. That actually happened last week. That happened just before Roaring Kitty got back on the scene last Wednesday. So, I'm not super worried about that. It might come back up. It might not. Maybe it goes a little sideways. I'm keeping my eye on it. It is a deeper support. Certainly intriguing if it stays there. But we did dip below this, I think 1 or 2 days last week, and then within a few hours or within a day, we basically popped back over it or right onto that trend line. So important to keep our eye on there. But even with that being said, that doesn't override sort of this other framework that I'm seeing. But again, I'm always trying to ask questions. I'm always trying to poke holes. This is a theory, right? This is a framework that I'm using. Right? The Greek word theory, right? Theorein means to perceive, to view, or to inspect, something like that. So this is what I'm trying to do. I'm trying to, this is a way that I try to make sense of what I'm looking at, but it's not law, and I'm trying to ask questions to poke holes in this, to try to find signals where I could be wrong or missing something, right? Because I miss things sometimes, or I don't know if I necessarily miss them as they're not there to be seen, but I'm not sure. That's what I'm trying to figure out, is my point. There's that. We didn't really test any of our other levels here. We still kind of have this the 100-day moving average kind of hanging out below us. Again, the moving averages are in fine shape. They're not, getting all crossed up and weird. 4 hour. Yeah, the 4 hour, right? Again, I was pretty happy to see that we did not log a lower low. That's what we like. We like to see that. No logging of the lower low. So, I'd rather go just completely sideways here, maintain these historic supports that we established all throughout this bull trend, just kind of consolidate in here, basically into mid-February. I would love that. That'd be amazing, right? That'd be amazing if we did that. Could you imagine what that would mean for us, consolidating in the 27s for a month? That'd be incredible. The last time we had a consolidatory period, right? We kind of consolidated here. That's what we did there. But then before that, the last time we consolidated, it was at 2050. This is way different. That's huge. That's consolidating more than 20. That's 20% up. So beautiful. Love to see that. OI stuff, pretty normal on the call side of things. The at the money stuff, 2930 doing its thing. What was really interesting to me was 2650 with the puts. I know we think, oh no, is somebody betting we're just going to fall to the downside and explode, and it's going to be terrible. Obviously, whenever I see, that's unusual to see that number of puts, right? We don't usually see puts come up on GameStop anyway, because especially long puts. We don't see long puts because well, we talked about this multiple times, but okay, you're bearish on the price, but you're long volatility. Ooh, you don't want to bet on, you want to be long volatility and bearish on GameStop. Like, because GameStop's IV goes down when the price goes down, right? That's different than SPY. That's the inverse of SPY. So you don't want to bet on, it's not helpful, right? So you're fighting against you. That's working against you. You're also long time, like you're long the time component. So your time's working against you and IV's working against you when you have a long put on GameStop. You want the price to go down, but these other factors are working against you while you're betting on that to happen. So at the money stuff, out of the money stuff doesn't work out so well if you're the long party when you're trading puts. So obviously I had to bring this up. And what do we get? Oh, it's a little Shane Gillis. Oh, for you. So what we saw there, I'm sorry, I'm feeling silly today. What we had, this is basically like all sold short. So this, some dude was like, I'm gonna sell 3,000. I'm gonna sell 3,000 calls. Short puts are a great snack when you like to sell short 3,000 of something. Yeah. So what that means is when we look at our checks data, that's going to be deceptively supportive. So with a short put, that means the dealer is long the gamma at that strike. The trader is short the trader is short the positive gamma. The trader is short the negative gamma. So there's positive gamma on the trader's books and there's negative gamma on the dealer's book. So as that strike is approached, the negative gamma is going to go up. So the dealer has to hedge that position by purchasing shares in order to offset that so they can remain gamma and delta neutral. So interestingly, that's going to be a deceptively supportive strike during the day today. So what that suggests to me is that we don't have that much downside from where we are. We're kind of in the upper 26, like 80s, 26, 90s pre-market. We don't have a lot of room to go to the downside. We know that 26 is at the very least, it's a neutral strike. Again, this was kind of deceptive. These look like, oh no, volatility is going to spike. But right, we're not looking at SPY, we're looking at GameStop. And we know 2650, we know 26, they have a lot of trader short puts there. So dealers are doing the opposite of what we would anticipate, what we would assume when looking at GEX distributions on SPY. So this is a deceptively supportive area. Now, it doesn't mean, oh, it's going to bounce and then we just rock it. No, not necessarily. Traders still have to act on that. But if they see this, like that's a very conspicuous trade. 3,000 calls popping up, or excuse me, 3,000 puts, 3,000 contracts popping up like that. And that trader didn't move. That trader didn't exit that. That trader basically made the market at that strike, to quote, Roaring Kitty on that. But so I think really, I mean, at this point, the value to capture is to move back to the upside. We've tested this area, haven't really been able to push through this area very well. Now we've got a wall of short puts at that level. Now it's not a crazy amount of support, but it's not none. It can be shorted, right? This is why I point out that lending pool. Institutions can come short us through that level. We have to respect that. That can happen if they really want to move it down. That can happen. But I would say, under normal conditions, under normal hedging structure, it looks to me like there is more room to the upside. There's more stuff to capture. Now, if they want the price down there because they got to roll a swap, they can do that. That's on the table. But I would say if they decide to leave stuff alone and just kind of let stuff stay flat, I think ordinary options flow is going to be something. It's going to be a little bit more bullish. It's going to take us back into the 28.50 area because there's just more room there, right? You're not going to want to. Why do you want to try to ram it down? Like if you're an options trade, in the options market, you're going to try to ram this down 50 cents max before you run into hedging resistance, and then you got to go the other way. You could do that, but that's not the path of least resistance. That's the path of greatest resistance. So unless you're going to come in and short that because you got to roll a swap or something, then I would not anticipate that the options market would be betting on that type of move. But we have to see. It doesn't matter what I think. It matters what the major players do. But that's what I'm seeing there. Volatility, as I said, approaching 52-week lows. Not there yet. another couple weeks, right? So we've basically, right, flattened out here. If you use a little comparison here, a little flat, started to move down. We're basically kind of here in this, maybe a little lower. We're like in this area in terms of this kind of volatility cycle. If we use the September sell-off, right? If we look at the cool-off period, we're basically here, right? We're basically in this area. So that's essentially another 2-3 weeks. 2-3 weeks, probably around three. Probably around three. What we're looking at to kind of scoot down a little bit more. Of course, they can always introduce a little chop, right? We see a little chop, little chop, little chop. They can do that. So that's what I'm looking at. Basically, again, I think I don't see a reason. I don't know necessarily. Okay, maybe there are a few of us who know about these volatility cycles. There are a few of us who can see these coming. I am powerless to do anything about them. I can't stop these from happening. So, do institutions necessarily care that I have this information or that we have this information? I don't really think they care about retail investors at all. I don't think they care about, me making little YouTube videos about this. I mean, Girk published this stuff a while ago. Plenty of people learned about this. Hasn't stopped them from doing this yet. So, the cycles they repeat, right? Time is a flat circle. Yeah, so that's what I'm seeing, kind of a consolidatory, kind of neutral, slightly bearish outlook. Do we have some temporary risk and possible downside for this swap roll? Yeah, it's there. Certainly, if Richard Newton has the timing on this, right? Why not? Seems to make a pretty good case of it. Definitely go check out his videos yourself. Really love what he's doing over there on his channel. But yeah, that's basically the outlook. That's what I'm looking at. Always trying to poke holes in what I'm seeing here. If you have any questions, you have any comments, if you'd like to poke some holes, go ahead and do so right now in the comments. Obviously, I'd love to hear from you guys. Always appreciate your support. Always appreciate you watching and listening. I appreciate hearing from you here and on X as well. So thank you so much. Really appreciate your time. I had a great time talking to you guys today. This was nice. Sun is shining on me. I'm feeling mood is good, right? Love to see the sunshine. Love to have some fun while we're looking at our squiggly lines and charts here. So thank you so much, everybody. We will see you. Yeah, we'll see you tomorrow, bright and early, or whatever time it is that you watch this, over tomorrow before market opens. So yeah, see you then. See you on Wednesday. Thanks very much. Take care, everybody.